Hello and welcome to today's video. Hope you all are doing great. In this video, we are going to talk about ELSS mutual funds and how they can help you save taxes. But first, let's define what ELSS mutual funds are. ELSS is a type of mutual fund that invests primarily in equities or stocks. They are also known as tax-saving mutual funds because they offer tax benefits under Section 80C of the Indian Income Tax Law. This means that if you invest in ELSS mutual funds, you can claim tax deduction of up to 1.5 lakh on the amount you invested that financial year. For example, let's say your taxable income is 7 lakh and you invest 1.5 lakh in ELSS. Your taxable income will become 5.5 lakhs, which will mean you have to pay tax on this 5.5 lakhs, which will finally be zero because of standard deduction offered by the government and the rebate of Section 87A. This can result in significant tax saving and depending upon your tax bracket. In addition to tax benefits, ELSS mutual funds also have potential to generate higher returns compared to other tax-saving instruments such as fixed deposit or public provident funds (PPF). This is because ELSS invests in stocks which have potential to grow over time more. However, it is important to keep in mind that ELSS are subject to market risk, which means the value of your investment may fluctuate depending upon the performance of the stock market. Therefore, it's important to consider your risk tolerance and investment horizon before deciding to invest in ELSS. Another thing to note in the ELSS is that it has 3 years lock-in period, which means that you cannot withdraw your money before the completion of 3 years from the date of investment. This is in contrast to other mutual fund schemes which may have shorter or no lock-in period. In case of ELSS, you get exemption for the amount invested, but returns are taxed as per the long-term tax, which is 10% on the total returns. It's important to note that long-term capital gain tax is only applicable if your total long-term capital gains exceed 1 lakh in the financial year. If you have long-term capital gain less than 1 lakh, then there is no tax liability. You might consider doing tax harvesting, which I will discuss in one of my further videos. Some of the famous ELSS mutual funds are One Tax Direct Growth, Mirai Asset Tax Saver Fund Growth Plan, and DSP Tax Saver Direct Plan Growth. You can see other top performing ELSS funds for the 5 years on the screen now. If you want to invest, you can do that via Grow or the ET Money. Links to that you will find in the description section. So let's see what are the benefits ELSS mutual fund providers. As mentioned earlier, ELSS offers tax benefits under Section 80C of the Indian Income Tax Law. You can claim a tax deduction of the amount invested up to a maximum of 1.5 lakhs per year. This can result in significant tax savings. ELSS invests in the stocks which have higher potential to grow. This means that ELSS has potential to generate higher returns compared to the other tax-saving plans, such as PPF or the fixed deposits. ELSS allows you to invest in the basket of stocks, providing diversification across sectors and companies. This can help to reduce the risk of investing in the single stock. ELSS are managed by the professional fund managers who have the expertise and the resources to research and select stocks for the fund. This can save you time and effort compared to the managing your stock portfolio. You can choose to invest in ELSS through various options such as lump sum, systematic investment plans, SIP, or a dividend reinvestment plan. This allows you to choose investment option that suits best of your needs and the financial goals. Like any investment, ELSS also have some potential drawbacks that you have to consider before investing. ELSS invests in stocks which are subject to the market risk. This means that value of investment may fluctuate depending upon the performance of the stock. ELSS has a lock-in period of 3 years, which means you cannot withdraw your money before the completion of 3 years of your date of investment. This can be a drawback for someone who needs money sooner. ELSS mutual funds charge an expense ratio, which is a fee to cover their fund's operating expense. This fee can eat into your returns. The returns from ELSS are not guaranteed and are dependent upon the market. This means that there is a possibility of losing money if the stock market doesn't perform good. ELSS are the best suited for the long-term investment horizon as they have a 3-year lock-in period and are subject to market risk. So, in summary, ELSS mutual funds are a good option for those looking to save taxes and also potentially earn higher returns. However, it is important to be aware of the market risk and 3-year lock-in period before investing. I hope this video helped you in understanding ELSS mutual funds and its tax implications. If you have any questions, feel free to drop the comment below. Thanks for watching. Nikhil Dhawan signing off.